Hello everyone, I'm Yasser Said. This is the class of Financial Markets and Institution, and we are going to continue with the money markets. Now, in the last lecture, we were studying financial markets instruments, and we have covered treasury bills. Today, we are going to continue with four other financial market instruments. The first one of today's lecture that will be repurchase agreements. Afterwards, we will study commercial papers, then federal funds, and then we'll have a detailed discussion on the letter of credit. So let us start with the repurchase agreement. A repurchase agreement involves two parties, and it involves the sale of a security by one party to the other party, but it is with the promise that the initiator of this agreement will repurchase those security on a later date on a specified price. So here we have to see two properties. One property is that a security is sold on the agreement that it will be repurchased, and the second thing, the date is specified and the price is also specified. Then there is another similar instrument that is called reverse repurchase. Reverse repurchase agreement is actually similar type of agreement, but in that the initiating party buys a financial security with the promise to sell that on the future date. So both repurchase agreements and the reverse repurchase agreement looks identical, but it depends on the initiating party. If the initiating party is selling on the terms that he will repurchase it, then it is a repo. Otherwise, it will be considered a reverse repo. So let us talk about the maturity of a repurchase agreement. These agreements usually have a maturity of 1 month to 3 months, but there is no hard and fast rule, and the maturity can be more than 3 months depending on the agreement of the two parties. Then what type of securities are traded in repurchase agreements? It is not the normal goods and services that are involved. It is not a watch or some gold-plated anything that is a commodity. Rather, it is a treasury bill. It is the security involved in it is usually a treasury bill, and it is usually sold on a value that is much less than the market value of the security. This is because if the initiator fails in repurchasing the treasury bill, then what will happen? The buyer of treasury bill will be able to gain from this treasury bill. The return is calculated as follows. The formula for calculation of repurchase agreement is PF minus P naught divided by P naught multiplied by 360 divided by H. So PF shows the face value, the price on which it will be repurchased. P naught shows the price on which it is sold to the second party, and 360 represents the days in the money market. As already discussed, it is not a 365 days a year, but 360 days a year, because for simplicity of calculation, if we divide 360 divided by 12, we get 30 days. So the market considers 1 month equal to 30 days. Here H represents the maturity of the treasury bill. If the maturity is 1 month, H will be 30 days. If the maturity is 3 months, H will be 60 days. Now the next instrument that we are going to discuss here is the commercial paper. A commercial paper is actually an unsecured short-term note issued by a company to raise short-term cash, often to finance working capital requirements. What is a commercial paper? It is a promise. It is a borrowing based on a promise. It has no security, it has no collateral in its backing, but a promise. And the company attempts to raise short-term cash, and that short-term cash is usually used for working capital requirement. What is working capital requirement? Usually in finance it is calculated by subtracting current liabilities from current assets, mean the cash that you are immediately the cash that is immediately required for running a business. There are some properties of commercial paper. Since it is unsecured, corporation with good credit rating can issue commercial papers. Only those corporations that are able to pay, that have the reputation of paying their loans, only they can issue. And how we know whether the corporation has a good credit rating? Actually, there are certain bodies which study these corporations, and they provide a list which shows how good a corporation is. For example, some corporations may have AAA rating, some corporations may have AA rating, depending on their ability to pay back the loans. Then again, commercial papers have a very high denomination. They are traded in millions, and it is not regulated by the State Bank of Pakistan. Instead, it is regulated by the Security and Exchange Commission of Pakistan, unlike other financial instruments which were regulated by the State Bank of Pakistan. Then the normal maturity of commercial paper again lies between 1 month up to 1 year, depending on the agreement. So the primary market of commercial paper, they are usually sold directly to investors. It does not involve advertising, but it involves a corporation who is in need of funds. That corporation approaches certain big investors. Again, they might be big banks, they might be big corporations who may be interested in investing in these corporations. So they issue directly to the investor rather than offering them through the newspapers or making any announcement for them. Since the investors hold them up to the maturity, there is no active secondary market. Nobody trades a commercial paper. Let us discuss a practical example of a commercial paper. We have here an issuer, K Electric Company, who wants to raise short-term funds, and the face value of that fund is 10,000 million rupees. So this will be issued at discount. The corporation K Electric will pay this much amount to the investors, but how much the investors will pay initially? They will pay the value given as a discounted value. And what are the certain properties of this commercial paper? It is rated, privately placed. There is no advertising, but that has been coordinated with the corporation. That will be coordinated with the corporation or investor that is interested in it. Then they are Sharia compliant. They follow the principles of Islamic finance, and again, the issue date and maturity date are given. Issue date is 1st March 2019 and maturity is September 2019. So apparently it is a 6-month, it has a maturity of 6 months. Then the credit rating, as I have discussed, commercial paper is not issued by corporations with low credit rating but higher credit rating. This is the credit rating given by VIS Credit Rating Agency, and that is AA/A1. Then what are the silent features of this commercial paper? It is issued for 6 months. The maturity of this paper is 6 months. The interest rate determined for this commercial paper is 11.75%. It is unsecured. As usual, commercial papers are not backed by any security, and it is also non-convertible. The investor cannot convert his investment into shares or any other type of financial investment with this corporation, and it is only redeemable at maturity date. That is, it will only be redeemed after 6 months. Okay, so how the yield on commercial paper is calculated? Like treasury bill and any other financial instrument traded in the money market, we have a similar formula for commercial papers, but there is a slight difference in the denominator. Let me point out to the denominator, that is the PF. Here it is slightly different from the treasury bill and the previous financial instrument that used P naught. Instead we are using PF, and PF is more accurate as compared to P naught. The proper formula for finding a growth rate is to divide it by the face value rather than by the offer value, again multiplied by 360. And the next instrument that we are going to study is the federal funds. So what is federal fund? It is actually a short-term fund transfer between financial institutions, usually the commercial banks, for a period of 1 day, or we may say that overnight transfer from one bank to another bank. So why for one night? What is the logic or the reason behind it? If you look at monetary policy, there is a tool that is called reserve requirement ratio. And reserve requirement ratio means that if you have to deposit 100 rupees, the reserve requirement ratio, given that it has been announced by the State Bank to be 40%, in that 100 rupees, banks can lend 60 rupees to customers, but it will have to keep 40%, the 40 rupees, as reserve. If reserve requirement ratio increase to 45, then they will lend 55 rupees, but they will keep 45 rupees as reserve. Practically what happens, firms do not keep these reserves throughout the day. They do their normal business, and what happens is that at the end of the day, when they start closing their banks, they check up their reserves. If they fail to maintain that reserves, they could be fined by the State Bank of Pakistan. So what they do, they borrow money from other financial institutions, from usually from other banks that have these excess funds that have more than their reserve requirement ratio, so they can borrow funds from them for one night, and on the on the next day they pay back the funds along with interest for this one night. Then federal funds are single payment loans. There are no cash flows involved. This is only a single time payment, so they pay interest at maturity. The maturity, as already discussed for federal funds, that is one night. So it can go up to 15 days, up to 20 days, depending on the agreement, but the usual maturity lies between the usual maturity is 1 day. The next financial instrument that is more interesting, it is called the banker's acceptance. It is a time draft payable to a seller of goods with payments guaranteed by a bank. When it is usually used for trading purposes. How? For example, there is a businessman, an importer in Pakistan, and he is importing goods from China. Let's say he is importing machinery from China, and that costs a lot. So if this is a first time trade, the investor, the importer in Pakistan, how will he trust the Chinese person with his money? He will not pay in advance because maybe that is a fraudulent activity. The good is not delivered at all. So there is a risk involved. Similarly, the Chinese person, since dealing with the Pakistani person for the first time, he is not aware of his credibility. So he cannot send the goods and then risk the payment. He may not receive the payment at all. So what happens in such cases? A guarantor is required, and this guarantee is usually given by banks. When this guarantee is given by the bank, we say that a banker acceptance has been created. So let us see the process of this banker acceptance, the creation of the letter of credit. The process involves two banks, one domestic bank. Here we have, in this example, we have HBL, and one Chinese bank, the foreign bank that we call the Bank of China. We have an importer in Pakistan, and we have an exporter in China. So what happens first is that the importer in Pakistan sends a purchase request. He requests for certain goods, but the payment will not be directly given to that person. Instead, what happens? The importer will request Habib Bank, his local bank, for a letter of credit, for a guarantee to the foreigner, to the Chinese. What HBL will do, it will send a notification to the Chinese importer. It will send a letter to the Chinese importer to deposit it in his own bank, and this will be as a security for the Chinese exporter. The Chinese person, the exporter, he will send goods to Pakistan, to the Pakistani importer, but he will not send the shipment papers. Instead, he will submit the shipments paper and the time draft that was sent by the HBL to him to his own bank, that is the Bank of China. Then in the sixth step, the Bank of China will send the time draft and shipping papers to the HBL. But what HBL will do, HBL will pay the foreign bank on behalf of the importer and will hold the shipment papers with him. What happens next is that the Bank of China send payments to the Chinese exporter, but the domestic importer will not be able to receive the shipment until he pay to the home bank, until he pay to HBL. As soon as he pay to HBL, HBL will provide him with the shipment papers, and he can take the shipment papers and receive the goods on these shipment papers. So this is how the letter of credit works. This is how the banker acceptance works. So again, this is a short-term financial instrument that completes usually within 2 months. So we have covered the financial instruments that are traded in the money market. Here are some of the money market participants. Usually there are the Federal Reserve System, the Fed Bank, commercial banks, mutual funds, brokers and dealers, and other financial institutions. Also some individual investors. They are the most common money market participants. So for treasury bill, we have all of them. Then for federal funds, there are no individuals, rather than there are usually banks and brokers and dealers and financial institutions. It does not relate to individuals. For commercial papers, that involves commercial banks and large corporations. And again, for banker acceptance, it is between commercial papers and individual brokers and dealers. And also, it is mostly related to the business of import and export. Thank you so much. If you have any questions.